Hello and welcome to Stockwatch Live. Retail's on the agenda again with full year results from Ocado Group on Tuesday and Superdry later on in the week. The last time we heard from clothing retailer Superdry, allegedly popular with middle-aged dads, the company issued a profit warning that sent the shares plunging. It said it expected annual profits to fall by as much as 40% and pinned the blame on a combination of unseasonably warm weather, changing consumer behaviour and economic and political uncertainty. That news, although echoed in plenty of other corners of the retail sector, prompted Superdry shares to lose a third of their value. Underlying pre-tax profits are expected to come in between £55 and £70 million. That compares to profits achieved of £97 million the year before. The Cheltenham-based retailer explained how the milder than usual winter weather that carried on throughout November and December hit sales of hoodies and jackets, and it's these items that it relies on selling enough of during the winter months. However, while the weather may not have been cold enough to shift sales, the relationship between founder Julian Dunkerton and chief executive Ewan Sutherland has been growing ever icier. The Superdry founder, who left the business earlier this year but still owns 18% of the shares, has openly criticised the way the company is being run. Barbed comments from both the chief executive and Superdry's chairman Peter Bamford show this hasn't been a one-way attack though. Boardroom bickering aside, investors will be all ears on Thursday for more about the clothing retailer's plans to move away from its reliance on outerwear. These plans include a licensing scheme that Superdry says should give it £10 million a year in royalties by 2022, and there's also been talk of a move into children's wear. Immediately after the warning, Michelle Wilson, an analyst at Broken Berenberg, said management had provided a very helpful and comprehensive review of the strategy and said there were plenty of reasons for optimism in the longer term. However, crucially, she added it was hard to tell how long it would take to turn the brand around. Analyst Kate Calvert at Investec, who has already more than halved her share price target to 600p, has also now trimmed her profit forecast by 30% for the current financial year and 37% for the following year. It is no longer appropriate to value Superdry as a growth stock until sustainable growth is proven, she wrote in a note to clients. Ouch. And that's from the house broker. Superdry shares are currently trading around 508p, a far cry from the £20.76 they were trading at the start of January last year. Now, there are no such problems with falling share prices at Ocado. In fact, this stellar performer has gone from strength to strength since the start of the year. And the news that Ocado is in talks with Marks & Spencer just added further to the performance of these shares. They were trading at just 519p this time around last year. Today, they're around the 978p mark. Back in May last year, Ocado saw its market value almost double after it announced a deal with Kroger, one of the world's largest grocers. That was a deal to license its software, a product that analysts at Bank of America Merrill Lynch dubbed a credible and profitable alternative to Amazon's threat and described as having almost no competition. This latest tie-up with M&S just seems to further endorse Peel Hunt's description of Ocado as the Microsoft of retail. And it certainly takes Ocado another step away from its traditional retail rivals and sets it up even more as a retail technology provider. The Brexit effect could be on the agenda when medical device maker Smith & Nephew posts full-year results on Thursday. Very much a global business, it's already said that while it expects underlying revenue growth to be in the lower half of the 2 to 3% range for the year, having run through the various scenarios related to the different Brexit outcomes, it doesn't believe the UK's decision to leave the EU should have a significant impact on its long-term ability to conduct business into and out of the EU or the UK. A flurry of broker recommendations look largely optimistic too. UBS remains neutral but has raised its price target from £13.40 to £13.90, while Deutsche Bank has upgraded its investment rating from sell to hold and raised its price target from £12 to £13.50. While Morgan Stanley has upgraded its rating from equal weight to overweight and raised its price target from £14.57 to £16.92. Only JP Morgan Cazenove has downgraded its investment rating from overweight to neutral. On Thursday, also look out for a trading update from global catering company Compass Group, which last pleased the market with a strong performance from its North American division. It's recently been tipped as a buy by broker Berenberg, who has an £18.50 price target on the shares. They're currently trading at around £16.09. And finally, to start the week, we get another update from the budget airline sector. This time it's the turn of Ryanair, which is due to post third quarter results on Monday. And what we're likely to hear, yet again, is that for an industry that on the whole caters for carefree holidaymakers focused on escaping the daily grind for a week or two, the day-to-day reality of running an airline, especially a budget one, is far from a holiday. Having already downgraded its full-year profit guidance due to a 7% slump in winter ticket prices, though, we have been forewarned. Ryanair seems to have been banking on more of the competition falling by the wayside, but with Flybe looking likely to be snapped up by the Virgin-led consortium, Chief Executive Michael O'Leary may have to come up with another strategy. Stand by for potentially further cuts to airfares and even slightly lower guidance on the airline's fourth quarter figures. Also, keep an eye out for full-year results this week from oil major BP on Tuesday, half-year results from house builder Barratt Developments on Wednesday, and a trading update from Electrocomponents too. Well, that's all for this week. To follow the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.